What's up, guys? What if I told you there was a way to access your IRA without paying any federal income tax on pulling those funds out? Would you believe it? Well, in this video, I'm going to share with you a strategy on how to do exactly that. Pull money out of your IRA and not pay any federal income tax on it. All right, let's get started. Okay, so here's the deal. What I'm going to be sharing with you is a strategy that if you have money trapped in an IRA and you want to gain access to it, but you don't want to pay taxes on that money because you realize, hey, if I pulled out $150,000 and the IRS was taking 25% of that, assuming that's my personal income tax bracket, then I'm really not going to have as much money as I need to go out and start my business or start my real estate investing. Well, if you're in that situation right now in that camp, then you're going to want to see what I'm about to show you, because here's a way in which you can tap into your IRA and not pay any income tax on it. Now, I keep saying income tax. I'm doing that for a reason. It's very hard to eliminate the 10% penalty on the withdrawal. So you may have to pay that 10% early access fee, but you're not going to get hit with income taxes. Now, you may take what I'm about to share with you and say, oh, well, here's a way for me to eliminate the 10% penalty as well on top of this. But generally speaking, follow along with this strategy and you're going to be amazed what it can do for you. All right, so what am I referring to here when it comes to using your or accessing your IRA tax-free? Let's assume that I had an IRA set up here, traditional IRA, with $150,000 inside of it. And I would like to take that money out and put it into real estate because I don't want to buy real estate in my IRA. In this particular case, I want that income flowing to me on a monthly basis. So I'm considering breaking this IRA and pulling the money out. So if I were to pull out $150,000, here's the way taxes will work. Assuming you're, under the age of 59 and a half, what's going to happen here is when you take that money out, you're going to pay 10% penalty tax on the withdrawal of that. So you're going to get hit with $15,000 in taxes because it's referred to as an early withdrawal. Now, the other thing you're going to run into is income taxes. Let's assume your tax bracket is at 25%. So 25% of $150,000 is going to be about $37,500. We'll just put $37K. So this is the problem for a lot of people that have money inside of an IRA. They look at this and they say, well, if I were to tap into the 150, I'm basically giving a third of it away to the federal government. So I guess I'll just leave it in there and keep putting the money into the stock market. But what if there's a way for you to pull it out, like I said, and eliminate this chunk right here? Well, there is, but what it requires is that you make a specific investment with these funds. So what I would suggest that you do, and the way we've worked with this with clients before in accessing their money, you pull the money out of the IRA, and then you need to go out and you need to put it into real estate. You see, this is one of the greatest tax strategies we have when it comes to investing. Or maybe you already have real estate that you hold in your portfolio. This will, if you already have real estate, this strategy will work well for you by following along with this. So you pull out $150,000. Now you take those funds, okay? Actually, you're going to have 135 because you got that 15 you got to hold back for the early withdrawal. You take that money, you go out and you buy a piece of property. Let's say you invest into a property for $600,000. In order to get into that, you have to have 20% down. Look at this. I have my down payment. So I buy this rental property here for $600K. Now, when I purchase that rental property for $600,000, it's going to produce for me on, let's say, an annual basis. Let's say this is an 8-cap property. Well, what's 8% of $600,000? Well, that's $48,000 a year. So now I bought an income producing property that's generating $48,000 a year of income for me. It's not going into my IRA. It's going to be coming down to me. So I can use that now for my living expenses. Maybe somebody's been able to cut back on the hours of work that they're doing, but I still haven't solved my tax issue yet, have I? So when you buy this property, okay, that is the 8-cap, we're going to do something different with it immediately. We're going to turn this property into a short-term rental for the first year. And when I mean year, I mean, let's assume that I bought this property here in 2024. I'm just going to run it to the end till December of 2024 as a short-term rental. What does a short-term rental mean if you're not familiar with it? 7 days or less average rental period. So you're going to treat it as 7 days or less average rental period for your tenants listed on Airbnb or Verbo, put it up there and rent it out, and just make sure that the average rental period comes out to being 7 days or less throughout the year. Now, with this short-term rental, okay, that I have here, what I'm going to need to also do is spend 100 hours and more than any one individual on this particular property. So this is where you have another planning opportunity here when it comes to running a short-term rental. Let's say you're turning that property quite a bit, and you have a cleaner coming in, and there's that cleaner comes in, and they spend on average between turns 4 hours. Well, if you have 30 turns, that's a problem. Now they're going to have more hours in you. So here's what you need to do. You need to get 3 or 4 cleaners all under that 100 hours, and then you're fine because you have more hours. As long as you spend 100 hours on your property, going out there, fixing up, doing whatever you're doing, as long as you spend 100 hours, managing it, then you just need to be more than anyone else. So I would split my cleaning duties among different people so none of them will exceed me. That's something you can be using. Maybe you're not even interested in this strategy, but you have a short-term rental and you're wondering about those 100 hours, do it that way. Okay, so here's the deal now. 7 days or less, okay, I talked about that. You have to average out for an average of 7 days or less. And so that all we do is we add up your total rental days by the number of tenants. And as long as it's 7 days or less, you got that one checked, and then keep a log of your 100 hours. So if I do all of that, then what you're going to want to do is take this property and perform a cost segregation study on it. Now, if you're not familiar with a cost segregation study, what you're doing there is you're looking at the property and you're saying, all right, this property we're going to accelerate the depreciation on 5, 7, and 15-year property. Now, those are aspects of your house that you can depreciate much quicker than the general structure, which would be depreciated at 27.5 years. So I'll tell you what happened with my properties that I've done this on. The company I work for, Cost Seg Authority, what we'll do is I'll tell them, hey, I got this new investment property. I want to perform a cost seg on it. They'll say, great, Clint, go out to your property with your cell phone. We're going to do a Zoom call. I grab my phone and I walk around the outside of my property, show them the roof, show them all the landscaping. Then we go show them the garage, and then we go into the house itself, and I show them all the rooms, kitchens, flooring, all that stuff. And then what they do is they prepare a report for me. And they add it all up, and they say, all right, so that particular structure of this type of property that's in there, your refrigerator, your tile cabinet, your electrical, things like that, the useful life of that is either 5, 7, or 15 years. Therefore, you can depreciate those much quicker than this. So on a cost seg study, your number is generally going to be looking at about 25% of the asset's value, sometimes even as high as 40%. So it really depends on the type of property you're buying. Obviously, the property you buy that has a larger structure and less land, the better off you're going to be. Now, let's assume that the average here was 30%. So if I perform a cost seg study, it comes back and 30% of that value here, all right, let's say that comes out to $180,000, is allocated to this property. Then what I'm able to use bonus depreciation, and I'm able to write off a huge chunk of this. So you can take these funds right here and use that. Let's say I write off $150,000 of that against my IRA distribution, and I wipe out my tax. Now, depending on when you acquired the property, you may not get a full 100%. It might be 80, it might be 60% of that. So you have to work with someone to determine how much is available to you. And that's why I told you, if you already have rental real estate, let's say you bought this property in 2020 and you have not used this strategy and you want to tap into your IRA, start looking at your existing properties, all right, that you own. Say you bought this one in 2021, and you can start using those with a cost seg study, turn them into short-term rentals this year, or maybe you're a real estate professional already, and start accelerating the depreciation with bonus depreciation on there. And you can take those at 100%. And again, those deductions start adding up. And so this is how you can tap into an IRA. Take your existing real estate, cost seg, bonus depreciation, and start slashing those taxes. And that's a sneaky way to get it out. In fact, if depending on how much you're able to write off, you may even eliminate everything when you pull that money out. Hey, if you liked the video, be sure to hit the like button. And you want to learn more about asset protection and tax planning for real estate investing, look in the show notes. I've got a Link for our one-day tax and asset protection live event every Saturday. You can attend this event. We bring our attorneys and our CPAs to this event to answer your questions. On average, we'll handle at least 12 to 1,400 questions per event, because the purpose of it is not only to educate you on these various types of strategies that you find on my channel, but also to ensure that you get questions, or you get your questions answered, because everyone's situation, believe it or not, is a little different. It's never a one-size-fits-all approach when it comes to taxes and asset protection for real estate investing. I look forward to seeing you there.